Hello, everyone, and welcome to another episode of Macro Matters. We're here on Friday, June 14th, 2024, Flag Day for all of you, those that like to celebrate Flag Day. And I'm once again joined by my colleague at both the CFA Society and at University of Illinois, Tony Zhang. Tony, welcome.
Yeah, hi, Rich. So glad that we are able to come here and discuss about the very exciting and also critical event that had happened in the past 1 or 2 weeks. I'm actually look forward to it.
Yeah, it was a pretty big week, right? Last
Yes.
Friday we had non-farm payrolls, then we got CPI and PPI inflation this week, and we had a Fed meeting. So there's a lot to discuss and a lot that's going on. And I thought I would put together some slides, and then we could just talk through the slides and see what's going on. And
Yeah,
then for those
exactly.
who are listening on podcasts, we'll try to really describe what we're seeing. But for those that can have access to YouTube, I think it would be optimal to look at it there. So I'm going to share my slides now for Macro Matters. And let's get it going here. So, the Fed, right? The Fed was, we're talking about jobs, we're talking about inflation, but all of that is only because we're trying to figure out what's going to go on with the Fed. And here is what the Fed is doing. So, I wanted to start first by showing what I think is maybe quietly one of the more important things that came out of the Fed meeting that I don't hear too many people talking about, and that's the change in the Fed dot plots. So
Correct. Yes.
every quarter, the Fed members change their own views of what they think is going to happen. And on the left of this, I have this is both from Bloomberg. I have the Fed dot plots from this past June meeting on the left, and I have the Fed dot plots from the March meeting on the right. And Tony, what I notice on this is that when I look at where the Fed is saying it sees rates over the course of the next year or so, that has changed. The Fed has clearly gotten more hawkish. A lot of people were interpreting the meeting as being dovish, but to me, the central forecast is that the Fed sees one cut this year and four cuts next year. If we go back even just to March, the Fed saw three cuts, the three cuts in 2024 and three cuts in 2025. And actually, if we went back to December of last year, it saw even more. So every meeting, the Fed has taken some rate cuts out of their own forecasts. And to me, that's a big deal. The market clearly didn't care, but I wonder what you think about it, Tony.
Well, Rich, 100% agree with you. I think the market is some kind of an overlook to the change or the difference of within the dot plot that have actually told us. Now, apparently, on this is exactly the dot plot on the left hand side, which actually shows the committee members like a projection of the future Fed fund rates, like was actually material different from the one actually on the right hand side from the March, like a summary of economic projection. And if we actually take a look at what had shown on the left hand side, it's now right now we only anticipated that the federal, from their point of view, might only have just one cut by the end of this year. Even the both of us has agreed this is pretty much impossible just for Federal Reserve to take a cut. But this is from let's look at from their perspective. They only anticipate that there will be one cut by the end of the year 2024 versus on the right hand side, which actually illustrated release from the March SEP meeting that there will be three cuts by the end of this year. And actually, even though from like what we look at the rate expectation by the end of the year 2025 was now here we mainly would anticipate it. Well, majority we would anticipate to see that by the next year the rate will be cut down to 4.5% roughly. Now, versus in the past, on the right hand side, with the expected rate by the end of the year 2025 will be 3.75. So here we can still see it's just like a huge difference here. So this is telling us, even within the Federal Reserve, now there's some kind of sentiments had shifted from more of a dovish to more of like hawkish extent, this is very, very important and very, very critical. And the reason I think we have been continuing to discuss over the past couple of episodes since the beginning of this year, apparently, number one, the resilience of the US economy, and number two, the strong labor market, and number three, I think so far what we have continued to see is the CPI has remained so stubborn here, right? I think the Rich is how I take from reading this like a fat data plots. What do you think?
Yeah, I would agree with you. I mean, we've been saying since early this year, really kind of January, February, that there would be no rate cuts, and the
Yes,
Fed seems to be moving in our direction. So
exactly.
that I think
That's
that because we're and I think another thing that's important, and they have the dot plots have what this year, next year, 2026, and then longer term, and longer term is really just where the central bank officials are saying that they see the so-called R star or the neutral rate, or where they think the rate is of policy that isn't either restrictive or easy. And
yes,
even that, if you look at it, back in March, they thought the neutral rate was 2.5%. This time they raised it up to 2.75%.
right.
And so even the neutral rate, the long-term neutral rate, went up by 25 basis points, which doesn't sound like a lot, but that's, oftentimes when they're putting together these forecasts, they're basically saying, what do we think is going to happen this year? And they're effectively then kind of drawing a line to where they think the R star is and how long it's going to take to get there. And
Yes,
so the fact that they see the long run neutral rate as being higher than they did before tells me that they think that inflation could be a little bit more of a problem, persistent problem than they've seen in the past. So I think that's kind of interesting. I didn't think the market was talking about it enough, but if we kind of go through now, we can look at here. I have on this chart this comes from the CME FedWatch tool.
mm,
And this is what the market, if we look at the Fed funds futures, what the market itself is implying at each of the next several meetings.
yes,
And on the left of this, we can see we can see the aggregated meeting probabilities. And so it's basically saying in July, 86, 85, 86% chance of no move whatsoever, only a
correct,
very small chance. But then by the time we get to September, the market sees an 80% chance of a cut. And then if you kind of get into November, it's basically 100% chance of a cut, and maybe even a little bit, 25% chance of more than a cut. And so the market's definitely seeing that September is the sweet spot of when to cut. We've been saying for quite some time that we thought that was too close to the election and that
correct.
the Fed wouldn't cut at that point. The market still sees that. I think that's what's giving some support to stocks here because they're still seeing the Fed as easing policy. I see it as the Fed is slowly taking cuts out, and they've been slowly disappointing the market and getting away with it. And so I still don't expect to see a cut in September, even though the market's priced it in. I don't know that's going to do to the market, but ultimately, that's what the Fed funds futures are saying right now. What do you think of that, Tony?
Yes, this is very interesting. Apparently, like the probability of rate cut at September right now actually just increased just maybe one day before from like roughly um 47% right now to roughly about 57% because you aggregate together. So we do the market really anticipated that there will be one cut in September. But as what we have emphasized before, I think this will show a stance that Federal Reserve is willing to take some influence over the presidential election, which is something that I think no one is willing to talk or discuss before that. So I think the chance to have a cut in September is still very weak, but maybe this might be some kind of a technique that leveraged by the Federal Reserve to actually to show the market that they are willing to take action if they actually see something happen, something bad happen. There's something bad happen here. Apparently, that number one is CPI probably will be still resilient. We can actually discuss later on. And the second might be a factor for the like a stats will be the labor market, right? This is something that
Yeah.
have been reflected over a couple of data in the past couple of days. So I think this is the only chance that they would take action will be to see some of like a accelerated weakness within the labor market. This might be the only reason, but before the presidential election, most likely Federal Reserve is not going to take any material action until really something really bad happen. I think I'm still stick to the call together with you. I think there will not be any cut by the end of this year, but there will be meaningful cuts very soon, just right after the presidential election could be in the early next year.
Yeah,
Rich,
and that's kind of
how
where the
I
market is. I
interpret.
mean, the market sees cuts, even two cuts into December. So they see them really kind of happening more aggressively a little bit after the election. And just so everyone knows, if you're looking at this, we've got the aggregated probabilities on the left and the conditional probabilities on the right.
Yes,
And what's this is what this the difference essentially of this is that when we use the options markets for the conditional meeting probabilities, there's a distribution of outcomes. It's not binary. It's not either cut or no cut, one cut or two
correct.
cuts. There's a distribution of outcomes, and that conditional meeting probability is showing you what that distribution looks like. And then the central tendency around that is what's showing up in the aggregated meeting probabilities. And so that's really what the difference is there. It's showing you that it's not just that everyone's betting either yes or no in September, but the majority, 60%,
Yes,
are betting for a cut. And then there's tails on either side. Some even 10% betting that there could be two cuts. And so that's how we get to that aggregated probabilities. And so yeah, the market is definitely still dovish, I would say, when it comes to the Fed. Still expecting the Fed to support whether it needs it or not. I still think soft landing with a rate cut is the base case for most people in the market. But as you're saying with some labor data, maybe it's going to be if there's a rate cut, maybe it's not because of a soft landing, but because we're starting to see elements of a hard landing. And I've got some slides to talk to that. But before we get to that, I want to, excuse me, show a couple other things. Here is a chart that I had talked about on LinkedIn this week, and this just plots the Fed funds target rate in blue. I'm sorry, in white versus the U.S. 10-year Treasury yield. And I've shown this over the last 40 plus years. And what you see is that it's actually quite uncommon for the Fed funds rate to be above the 10-year Treasury yield. The 10-year Treasury yield can be seen as, in some ways, it can be seen as the market's expectation of where the Fed rates will be cumulatively over the next 10 years. And so the market is essentially saying that over the next 10 years, it sees rates, over 100, 110 basis points lower than where they are right now. And if you
correct.
go back in time, you can see that almost every time that we've had the Fed funds rate above the 10-year Treasury yield, I have the red shaded area there. We've had a recession in fairly short order. And what that's telling you is that the Fed had raised the rates so much that a hard landing happened, a recession happened, and then they had to cut. And then when they cut, they brought it back below the 10-year. The only period, if you look really closely, the only period where very briefly the Fed funds went above the 10-year and there wasn't a recession was back in that kind of mid 96, 97, 98 period, somewhere around 1997, because that was the Asian financial crisis and then the LTCM crisis, Brazil, Russia, debt problems, et cetera. So there were a lot of exogenous things going on around the world. And the Fed was cutting to provide liquidity essentially to global investors more than the US investors. And but every other time, Tony, we've seen this Fed funds
Yes.
rate above the 10-year, we've had a hard landing because that's typically seen as restrictive policy. It's recessions don't happen from old age. Recessions happen because the Fed causes them. But this is something that, you can look at another way. It's the inversion of the yield curve is another way to say this, but it's been persistent for quite some time. And I've seen others explaining it away that this is the Fed, buying mortgage-backed securities, um, buying 10 years, even though they're doing QT, they're letting bigger chunks roll off, but they're still buying. I don't know how you see this. If you see this as a warning sign, or if you see this as just kind of the mid 90s bull market type of psychology.
Well, Rich, in my opinion, I think it's more likely will be the case that we will see a hard landing probably early next year than a soft landing. or even no landing. Well, apparently that we could be wrong at the beginning of this year that we or I anticipated it will be a soft landing happen this year because of the yield curve inversion, as you just mentioned. However, right, there are actually two main reasons that we or I actually overlook at the beginning. Number one, apparently, I did not anticipate it. The labor market is so strong. I think that actually provided the huge support for the rent, the rental expense, which actually become a very core element for the inflation within the inflation calculation. And now this is actually very providing a very good support for all of the consumer expense, like the consumer expense leading to a better than expected like corporate earning, which actually have been reflecting the Q2, right? Over the Q2, still more than 70% of the S&P component companies reported better than as expected earning. So this is actually provide a very solid foundation for the market, but actually continue to go up. But looking forward, whether the situation might continue to getting better. Now here, apparently the interest rate play a huge factors right now, right here. From the corporate evaluation perspective, now if we actually look at, there are a couple of things. One, on the numerator, typically from our like a cash flow discounted cash flow model, DCF model, on the numerical factors, we would anticipate that the corporates might have to have a higher cash flow, right? It's like if they continue to have a better than expected cash flow, apparently the current, when they discount the present value will be higher. But if we actually look at the denominator perspective, which actually will be the discount rate, where typically in our traditional finance we use WACC, but within the WACC this is a couple components. One component will be the cost of the debt. The cost of debt is directly related or proportional to the risk-free rate. Now, with the higher for longer policy adopted by the Federal Reserve, the discount rate will actually tend to be inflated. That actually will leading to the lower valuation for the stock market. Now, right now here, this is I think there's a two forces are playing within this the fractal. Now here, whether the growth of the company's revenue or cash flow can actually outbid the actually the going higher, the inflated discount rate. With the high inflation here, I think the consumer start to feel the pain of the inflation. As what we discussed in the last episode, I think now many consumer have already cut back their actually the traditional expense. Even like they actually slow down in paying for the gasoline. They actually cut down the expense for their like maybe some sweet treat Starbucks, right? The Frappuccino, you know,
Yeah,
even if
sure.
like Starbucks actually reported earning or reported sale that ungrow as what they used to be. That's actually telling us that the consumers, like especially the younger generation, actually didn't even think that a frappuccino will become a very nice sweet treat or even a necessary treat or expense anymore, like what they used to be, right?
Yeah.
So I think the sentiment change within the consumer actually also play a very important factor. So from the consumer staple and consumer discretionary factors sectors, we have seen the continued like a slowing down of the revenue growth for those companies. That's actually provide a huge um, warning signs. I think this is I believe the investors should pay attention to this kind of weakening
Yeah.
consumer
Yeah, no, I
behavior.
agree. And I think,
Yeah.
to that point, not only have we seen Starbucks earnings struggle, we at some of the other major retailers, we've seen the white labeled products or the generic products picking up in sales. And if you look at Costco, their
Yes,
earnings have gone very, very well because people are buying in bulk to get
correct.
lower prices. And so there's clearly that sense that's really not. But I think another thing that's interesting to me on this, when I look at this, is like there's two things that stand out to me. One is one thing we've talked about since the start of the year is that there could be three scenarios at play this year. One is
Mm,
that we have a soft landing and we get a rate cut, which is what the market's been betting on all year long, which is why the market has been strong. There's two other scenarios, though. One of them that you highlighted is that if we get a rate cut, it's because of a hard landing, not a soft landing. And that is not very favorable for riskier assets. That's
correct.
not, it's a very low probability. I think based on the Bank of America, Merrill Lynch fundamental surveys, it's something around 10%. But that's something that we can't rule out. So we should explore that more. And then the other one is that, as you kind of mentioned, with a scenario of like no landing, there's probably a bigger proportion of investors that think no landing and no rate cuts.
Correct.
And that's the higher for longer, no landing, economies chug along just fine. And then so that's a we have to consider that there's still those other scenarios, and that's probably one that where you have to be really careful about, or we're really focused on where you want to spend, and that's the bifurcation I think that we're starting to see because when you look at this cash rate being really high, the long term rate being a little bit lower, the companies and the consumers that have a lot of cash are earning a lot of money right now, and they have that money to spend. The large cap companies with a lot of cash are earning that 5.5%. They don't have to go out and borrow money for growth, et cetera. The
Correct.
small cap companies are paying higher rates.
Oh,
They're not cash rich and they're having to go to the banks and they're paying higher rates. And we're seeing a huge bifurcation, not just in the economy where wealthy individuals are doing better than poor individuals, but we're seeing it within companies where wealthier companies are doing a lot better than poorer companies. And so I think that to me that's not necessarily a longer term healthy sign. It certainly can be a short term healthy sign because that can continue, but that's something where we want to see what's going to cause that to change. Um, just showing you the 10-year yield here on its own. It's down to 4.21%. I for one, I was wrong on this. I thought we'd be at closer to 5% by this time. It
break it
started the
out.
summer into the summer, as it looked like the yield a couple different times was trying to break out to the upside, but the bond market is proving me wrong, and it's the fact that the 10-year has pulled back so much down to 4.21%, even in the face of all the Treasury issuance and the persistent inflation data. That's what's underpinning all the risky assets that I show here on the next page. Here I've got the 10-year yield in white inverted. But what we're seeing here is that as the 10-year yield is going lower, so in this chart, as it's moving higher, that's leading to PEs going higher in the stocks. It's leading to Bitcoin going higher. It's leading to gold going higher. So all the things that investors have been long this year, Bitcoin, gold, and S&P, are all going to be favorably benefited by the 10-year yield going lower. So the 10-year yield definitely caught me off guard, and I admit that I'm wrong on that 10-year yield. I don't know if what you feel about the 10-year and what that's telling us for these other assets, Tony.
Rich, lots of information are actually embedded in the graph that you are actually showing here. Now, with actually the 10 years actually yields are going lower, there could be multiple explanation. One explanation will be that people will start to see the economy or the inflation might be actually going down in the long term. That might be one explanation. Or the second explanation will be investor, especially institutional investors, are taking more of a risk averse attitude toward the investment. So when they in finance, like when they choose a 60-40 ratio between the equity and bonds right now, is that whenever they actually raise their exposure or the weight allocation toward the bonds, that we typically will see that the yield 10 years treasury yield will actually decrease. So in this scenario, which definitely show the defensive gesture from institutional investor. And uh, what that is telling us right now, the recent movements within the market, especially with the divergence between the large cap and small caps, actually are not only driven by the retail investor, but also have been driven by the institutional investors, like their stance or their action. Now, here, as what we actually emphasized from the beginning of this year, like with high higher for longer interest rate policy, definitely this kind of economic environment or interest rate environment will favor the large cap company, especially the large cap tech. This is still so far it is still the case. Well, the when interest rates stay higher for longer with inflation so high, Rich, you actually mentioned a very great point. Those small cap companies would actually suffer, and they will continue to suffer through the end of this year. Now, the Federal Reserve, do they know it? Apparently, they do. Now, why do they continue to hold it? Yes, could be one explanation will be to say, hey, we still have the inflation remaining so stubborn. But on the other end, it's like what we can show is having a high interest rate here would versus like the global uh, emerging market, the interest rate environment out there in Europe, in Canada, when they actually lower the interest rate, many countries already started to do that, right? Canada, I think France might have already lowered their interest rate, or they have already taken one cut. Now, this will actually give the U.S. like market one slightly benefit or incremental benefit versus the rest of the market, because whenever the capital actually might actually flow from the emerging market to the U.S. market as long as the interest rate spreads remain high. This is a show that U.S. dollar remaining actually very strong. I think, Rich, we can maybe discuss this like later, but this actually was telling me this could be really the case. I think there's a more actually investor actually taking or some kind of defensive approach to get into the bond and pushing the like 10-year treasury yields lower. This definitely would help the valuation for the large cap tech, certainly for sure. And
Yeah,
small
and I
cap.
think it's super interesting when you bring up the fact that inflation and rates are hurting small caps a lot, and is that going to impact Fed policy? Is that why the Fed still thinks it needs to cut rates because the regional Fed governors are telling them that their companies that they're talking to are hurting? And I've heard that theory talked about. I heard the theory even that because baby boomers are cash rich, higher interest rates are actually stimulating the economy and not hurting the economy. And
Yes.
I can certainly see that point. And people talk about the goods deflation, et cetera. We're going to get to that chart in a second. But boomers are not buying goods; they're buying services, and the prices for that continue to be quite high. And
Correct.
so I can certainly be sympathetic to that argument. I saw a good post from Mark Higgins, who wrote the book Investing in U.S. Financial History. Someone who has been on a guest on our podcast before, and he's talking about how if the Fed is sympathetic to that argument and they lower rates, even with inflation problems not solved, we definitely risk a revisiting of like the 1960s, 1970s scenario where inflation becomes unhinged and then they have to be even more aggressive. If they're thinking everything's under control and they're going to ease just to help the small caps, it could really get out of their control. And again, he's written the book on it. I haven't, and so I think that's something that we need to be kind of mindful of and cautious of. But talking about inflation,
Yes.
this is the data that came out that everyone is really excited about because CPI was 0.1% lower than expectations at 3.3, and that's the white line that I'm showing here on this graph. The year over year was at 3.3 versus 3.4 expected. And the month over month was at zero. It's touched there before, but it's been bouncing. The month over month has been bouncing between 0 and 0.5%. And many are extrapolating saying, see that the CPI is at zero month over month. That means it's going to definitely fall back to trend. I'm not so sure that I kind of see it the same way. I sit there and see the year over year at 3.3%, which is well above the Fed's 2% target. And so I don't see personally, when I look at that CPI data, even though it was a little softer than expectations, that this allows the Fed to take their foot off the gas. Though I will tell you that a lot of people in the market are looking at this and especially seeing that 0% month over month and seeing that the CPI is moving in the Fed's direction. I see that month over month is too noisy for me to really want to extrapolate and forecast. But I don't know if others that you talk to, Tony, or how you feel about CPI, but I still think I look at this data and says I think the Fed has more work to do. Others look at this data and say the inflation's moving in the Fed's direction, which camp would you be in?
Yeah, I, Rich, I definitely agree with you. This is two sides we can look at it. Apparently, the market is interpreted in both way, as we discussed. Actually, they have been reflecting to the market both way. So uh, whenever the data came out, the market actually went down. And now when they actually digest by listening to what Chair Powell has actually spoken in the conference meeting, that the market actually went up. So you can see the market actually really showed the divergence. They try to digest a different opinion. This is a very difficult to interpret in a correct way, because this is just so complicated. It cannot be just simplified as what is say, hey, because like the monthly came in like on a month to month, it's actually 0.1% lower than the expectation. And on the other end, 3.3% on an annual basis is still very high than the long term like a neutral rate, 2%. I think the Federal Reserve would have a very hard time here, and I don't believe it. If they actually dual mandate, they stick to their dual mandate employment and controlling the inflation here will allow them to actually to soften their stance and cut interest rate as soon as quickly, or as soon as the market has anticipated. We know market has been um, overly optimistic about the reality. So this is not interesting, not a good sign. On the other hand, I think the core inflation, like came in was like a 0.2%. Core inflation exclude the foods and energy. I think it's also lower than expectation. We know
Yeah.
that recently the energy price has come down. The crude price, gasoline price has come down slightly. I think there could be multiple factor, multiple explanation. One explanation will be, well, either whether the consumer would actually spend less on gasoline, and from the data that recently have shown, this is not the case. So there could only be explained by the second case. This might be actually due to the political consideration. The political consideration will be the presidential election for the year. We know that right now, a lot of people, lots of middle class have been complaining about the high inflation, and especially high the gas in price. They probably do not understand what this like a 3.3% CPI mean, but they are paying for the like a $4 per gallon on at a gas station, right, Rich?
Yeah,
So
for sure. And I
that's
think that's a great point. And I think when you look at the CPI, you look at the core, whatever you want to look at, and I know a lot of people talk about how goods prices are going. Actually, I think we had a negative print on CPI goods prices. But
yes.
when I look at it post COVID, people aren't really buying as much stuff. If I look at those who have the money, the baby boomers with cash, they're
Yes,
not buying stuff. They're buying services. They're going out to restaurants to eat. They're going on vacations, et cetera. There's the services inflation has not come down, and I think that's where people are
exactly.
spending their money, and that's where people are feeling the pain, right? It's one thing to
Yes,
say, okay, I can get something cheap from Amazon. That's great, but it's another to say I want to take my family on vacation and I can't afford it. And I think you're absolutely right that it's going to impact the election. So the next
yes.
chart I have to that point is the super core, which is the J Powell super core, and this
Mhm.
is coming from Bloomberg. And this is again, this is the core CPI ex housing services inflation. So
Yeah,
some will say that Jay Powell doesn't care about it because he hasn't referenced it the last couple of meetings. Though even though he hasn't referenced it, it's been going higher, and the Fed's been getting more hawkish on their dot plot. So I'd be surprised if they aren't looking at it. But this core, the super core, so the services inflation that I'm talking about, is still at 4.83%. It ticked down a little bit from last month when it was closer to 5, but it's still 4.83%, which is, if you look back pre-COVID, this services inflation was actually below the goods inflation. It was somewhere in, around the 1.5% range, got as
yes,
high as 6.5%. So it's been really below goods inflation quite a bit. It was not impacted by supply chain difficulties, et cetera. It's just been
Uh,
persistently higher because workers are asking for higher and higher wages. And
yes.
so the large cap companies like the tech companies, Google, et cetera, or the financial services companies like Goldman can either not hire them at the higher wages or fire them to keep their margins intact. But the small companies are really feeling that. And the smallest companies that we go to visit are the restaurants, and we're definitely seeing costs passed on there. Now, the bullish story is that if I look at the month on month again, it was actually flat or down a little bit. And somehow that's supposed to be a predictor that this is going to fall gently back to pace. But I still think I look at this and saying, and I know I'm anecdotally in my own life, the services inflation that I'm seeing is still very, very rampant. And I don't see how that's again how I think that the Fed, if they are start to easing, looking at some of the goods prices, are going to have a risk here. Are you seeing services inflation in your life, Tony?
Well, certainly, certainly. This is a huge issue. We continue to see right now the average wage for the service servant or service peoples within the service sector continue to actually to go up. That underscoring right now still the tighter market within for this particular sector, and that's actually provide the strong support for the core inflation index, as we just really mentioned. But this is one very interesting thing that we should probably discuss as well, because this is highly related to the inflation. And one thing that apparently when we look at this kind of index, which has been excluded the housing, but housing, why the housing has become so strong? Apparently, one thing is we continue to see the bull market. The bull market actually provided a very nice economic or financial support for people to afford the housing. And the second is the labor market has still become so good, so benign, so that the people can afford to pay the rent. Now, the rent is actually a very great component within the component to calculate the inflation. Now here, because of the labor shortage within the servant sector, then uh, they can demand a high wage. Whenever they can demand a high wage, they can actually to utilize the high wage to actually to afford the high rent when the rent going higher. So this is a kind of a cycle loop here. But if actually the cycle, the positive feedback cycle had been reversed, the situation would get really worse. So that's why right now the labor market is the market that I think many investors, especially institutional investors, should highly focus on, Rich.
Yeah, that's a great point. And I'm going to kind of click into a few more slides here, and I'm going to go through maybe a little more quickly in the interest of time. But I think as you're kind of some of these are some of the things that you've been discussing, Tony, when you're talking about the consumers. So today we got the University of Michigan data, and we got the inflation expectations data within the University of Michigan has always been kind of watched by the Fed. And I compare that. So that's the white line is the 1 year inflation expectations where consumers that went up and the consumers see inflation at 3.3% over the next year. The blue line is the 5 year expectations of inflation. So consumers are seeing inflation for the next 5 to 10 years at 3.1%. That's not quite all-time highs, but pretty darn close.
Yeah, yeah,
Whereas if the purple line I have is the 5 year forward inflation expectations, and the orange line is the inflation expectations embedded in the tips market. So those are market related measures, and those are somewhere around 2.2 to 2.5%. They're looking like they're kind of falling back to earth. Another example to me, I think, when I look at this, now again, the market expectations are always lower than consumer expectations, but the consumer expectations are high and rising, where the market expectations are falling and are near trend. So it's one where I think the market again is showing that it's kind of out of touch with what consumers are feeling. Maybe the market's right, maybe consumers are right, but I think this is important to note, and we've kind of been talking about that, so I don't want to spend too much time there. But I think to your point, maybe one of the other things that the consumers are worried about is jobs. You've talked about the strength of the jobs market.
yes.
I look at that. I have the non-farm payrolls number here in yellow, and it was quite strong last month. If I look at the green line is the household survey. So the yellow line, the non-farm payrolls, that's where the government goes around. They ask companies how many people you're hiring, et cetera, right?
Yes, yes.
The green line is they call up a bunch of people and saying, how is, do you have a job or not? And so what we're seeing is that the companies are presumably hiring, but when they talk to individuals, they're seeing they're not getting hired. So they're actually then that number is negative. Now the household survey is a more volatile data point, but what we've seen in the past is when the household data becomes disconnected from the non-farm payrolls, whether it's up, to the upside or the downside, those inflection points are typically important things to note because that's usually when the economy is either going into a recession or coming out of a recession. Consumers, while volatile on a month-to-month basis, have a better sense of what the economy is doing than even the bigger companies. And so consumers are not only worried about inflation, they could be starting to get worried about jobs, even though the companies aren't worried. And I think that could have election impacts, as we've been kind of talking about. Here I have this is from Real Clear Politics. I have the polling numbers in orange for Donald Trump and in blue for Joe Biden. You can see a little bit more volatility in the Joe Biden numbers, but over the last month or so, they actually, this actually, sorry, this one only go out to March, but it's been kind of sticking around here.
Yes.
You know, when the economy looks to be good, Joe Biden's numbers tick above Donald Trump, and when the economy looks to be bad or consumers are worried, the Joe Biden's numbers tick below Trump. And so I think that's something to kind of note here that maybe as we get into the summer, we get into the start of the election season, consumers, how consumers are feeling might impact this. And then one last chart for you, Tony, as we kind of wrap it up, is this is the V2X index, which is the European Volatility Index, which tracks European stock markets.
Mhm.
In blue, and the white line is the VIX index, which tracks the S&P 500 volatility. And you can see that while there's a spread, the V2X typically trades above that because it's based on fewer stocks and et
Correct.
cetera. And so it's going to be a little bit more volatile, but it's shot higher in the last week. While the VIX is still very, very subdued, near the lows, certainly of the last year, not quite all-time lows, but near the lows of last year. And one of the things we've seen in the last week as well, I know it's been a huge week, has been all of the elections in Europe, where maybe it's a protest vote, et cetera, but the far right parties throughout Europe won in the European Union parliamentary elections, and that was a counter vote versus the parties that are in charge right now, leading to new elections being called in France. We already have new elections being called in the UK. So as we get this political uncertainty creeping into Europe, we see volatility shooting higher. If we see any sort of political uncertainty creeping into the US, will we see volatility higher? I know I packed a lot in the last few slides, Tony, but what do you think about how we should be thinking about the elections and politics? Because here we are, kind of in the summer now officially, and this is when consumers are talking to all their friends about politics, and the debates will start soon, and we'll have the conventions next month. We're getting very much into this political season here in the U.S.
Yeah, I really like the chart, Richard, that you put it, and we are entering, I think, an unprecedented era within the U.S. political history, and especially this year. We have over the past, I think, 2 weeks, we have seen, I think, in the U.S. history that former President Trump had been indicted. I think for the first time. I think this is also the first time ever that a former president had been indicted, right, in history.
Yeah.
Now it's over, I think, just 72 or even less than 100 hours later that we are seeing that the son of the sitting presidents had been indicted as well. So if we actually look into that, is whether they have only any like a impact over our investment decision. I think that probably if something that has been overlooked before, now this is like to really try to cause the maybe the attention of the investor, especially some for retail investor as well. Given right now, I think most of the capital had flown into not just Magnificent Seven. I think it's really less than Magnificent Seven, right? Magnificent, we call it M4, right? Only Nvidia, Meta, Apple, and Google. This is like they this are actually telling me a lot of issue because they are actually $3 trillion company. For those kind of $3 trillion company to actually continue to go up, the capital actually, I think it's more like a black hole to continue to actually to attract all of the huge amount of capital coming in, and this will left it's like no room for any mistake, including the political uncertainty over the market. Any uncertainty, any shock or surprise would actually cause a huge shock over the VIX immediately. That telling us that could be the market could actually tumble dramatically within a very short time. Given right now, only like a 4 company or those 7 company had taken more than of the 50% or 40% weight of S&P 500. So this is really concerning to me, Rich. I do not know how you feel, but this is to me, this is a very concerning side. In the past we talked about pretty 50, nifty 50. Now
Yeah,
it's
yeah, nifty.
nifty, or not even the 50, the nifty 5 or nifty 4.
Yeah.
So this is very concerning. So I feel this is what I actually I'm thinking is it would be better like sometimes could take a more of a defensive way than actually aggressive way, given the current situation, especially now in the presidential year. We know from both party, the Democratic Party and also the Republican, would try the approach to try to stabilize the market, which actually have been a very important factor for both presidents. Actually, both have claimed that during their presidency, the market has reached the record high. So both of them were trying to claim the credit or championship. Yeah, they value this is dramatically, and I think this is something that what we can still hope, but the huge uncertainty, the risk continue to be built up. And you pointed out that the right wing actually won in the European election over the last weekend, and definitely the election around this year definitely should highlight the need for political leaders to communicate and execute a sensible policy in a very cautious way. Any mistake happen, it could be a big disaster for investors.
Yeah, and I feel for active managers right now because to your point, there's basically four names carrying the market every single day. In some ways,
Right.
in some days it's only one because Nvidia
Yes.
volumes trade more than SPY and its SPX volumes. But as an active manager, it's hard to be materially overweight just those four names and underweight everything else.
Exactly.
That's
Exactly.
not a good that's not a way typically to maintain your capital. However, if you underperform, you're also going to have your capital pulled. So it's a very difficult place for active investors to be. And so I'm sure it would seem to me that they're not going to want to make any changes to their portfolio until they absolutely have to. And so until we see some problems start to percolate, I wouldn't expect investors to change their portfolios. I wouldn't expect to see active managers selling those four names to buy other names that have been lagging, for instance, small cap names. However, for the rest of us that can't afford to be things in other places, you might want to look at taking some of your profits off the table because there could be there could be some problems ahead, especially if the market gets disappointed on rates, especially if the market gets disappointed on inflation, if the jobs numbers start to turn, or if all of a sudden we start to see political uncertainty pick up. And those are the things that we wanted to highlight here. Any final words for us, Tony, before we wrap it up?
Yes, Rich. Summer is typically the period where we see some kind of a lighter liquidity, and that actually will be translated into the higher volatility. So maybe at this moment, it's actually better for investors to actually to look to weigh, and instead of actually taking a very active approach as what you suggest, which is like don't take too much of active investment, but rather a passive investment. If you still want to get exposure to the market, might be a better way or better approach at this moment.
And you can still get 5% sitting in cash, and that's
Yes,
never a bad second choice.
yes,
So thanks everyone for joining us for another episode of Macro Matters, where we talk about the macro that matters. Tony and I will come to you again one more time before the 4th of July holidays, but one more time
yes.
for the end of the month. And we'll see whatever we're talking about at that point. I don't know what will be interesting at that point.
Well,
Maybe
this
we'll
is
have to.
a lot of interesting things, Richard. We can talk. I think we can talk about the style. Now, we have seen a huge divergence between the growth and the value, the large cap versus small cap, especially right now. I think what is very interesting. A lot of people will continue to ask this, whether the AI here is a bubble,
All
right?
those are all great points, and so I look forward to discussing
Yeah,
those
me
again in
too. Me
another couple
too.
of weeks. And thanks to you, Tony, and thanks for
Yeah,
everyone for listening. And thanks for joining Macro Matters.
yeah. Thank you, Rich. Thank you, everyone.